The streets were silent, the stores half empty, and the world was holding its breath. For the first time in modern history, entire economies had stopped. But the money didn't. Out of nowhere, checks began to arrive in mailboxes across America. It felt like a miracle. For a moment, people believed that maybe this time the government had finally done something right. Bills got paid, fridges were filled, and families who had never seen help before suddenly had hope. It was called stimulus. Free money, they said, to keep the world turning when everything else had shut down. But what if that money wasn't free at all? What if the real cost of those checks wasn't written on paper, but hidden in every dollar we spend today? What if the same act that promised relief quietly set fire to the foundation of the economy? Because money doesn't just appear out of thin air, and when it does, someone, somewhere, always pays the price. This is the story of how good intentions collided with economic reality. A story that begins with fear, accelerates with relief, and ends in one of the most expensive lessons in financial history. When the pandemic hit, the world didn't just face a health crisis, it faced an economic one. Millions lost jobs overnight. Businesses vanished. The stock market crashed faster than it ever had before. Governments were desperate, and in their desperation, they reached for the oldest trick in the book: print money. The United States unleashed over $5 trillion into the economy in the form of stimulus checks, relief programs, and business bailouts. For a brief moment, it worked. The markets bounced, spending returned, and people started to believe that printing money could fix anything. But beneath the surface, something began to break. Because what was meant to be a temporary fix turned into a permanent addiction. The system got hooked on free money, consumers, corporations, and even governments. Prices started to rise, debts started to balloon, and the value of a single dollar began to quietly erode. The same checks that were supposed to save the middle class became the spark that ignited a global inflation crisis. Corporations made record profits while working families paid record prices. Home ownership slipped further away, savings disappeared, and the gap between the rich and everyone else widened faster than ever before. But this isn't just about numbers or charts. It's about how one decision reshaped the psychology of an entire generation. The idea that governments could simply create money without consequence became normal, and yet every policy, every rescue package, every promise of temporary help carried a hidden cost, one that we are now paying through higher grocery bills, rising rents, shrinking savings, and declining faith in the system itself. In this story, we're going to uncover the real cost of free money. We'll trace how stimulus checks went from a symbol of hope to a trigger of inflation, how they changed spending habits, distorted markets, and quietly rewired the global economy. We'll follow the money, from Washington's printing presses to Wall Street's trading desks to your local grocery store, to see how a wave of relief became a storm of consequences. Because every dollar has a story, and this one isn't about generosity. It's about control, timing, and a truth that no one wanted to face. When you inject trillions into an economy that's standing still, the short-term relief becomes long-term regret. By the end of this video, you'll see why stimulus checks didn't just break the economy, they exposed it. They revealed the fragile architecture behind our modern financial system, where trust, not gold or productivity, backs the value of everything. And when that trust is stretched too far, it doesn't bend, it breaks. Chapter 1. The day the money printer woke up. March 2020. The world froze. Streets emptied, markets crashed, and fear spread faster than the virus itself. Millions of jobs vanished overnight. Panic filled the air, and governments around the world scrambled to find a solution. In the United States, one idea rose above the rest: stimulus. Within weeks, the money printer roared to life. Trillions of dollars were approved and sent directly to citizens, businesses, and banks. Checks worth $1,200, $1,400, and beyond appeared in mailboxes like government blessings. People called it relief. Politicians called it recovery. But behind those smiling press conferences, something irreversible had begun. The Federal Reserve's balance sheet exploded. The supply of money in the economy skyrocketed faster than at any point in history. And for the first time in decades, the line between responsible economics and political survival blurred completely. The world had discovered the power of free money, and once it started flowing, no one wanted it to stop. What began as an emergency measure would soon turn into a trillion-dollar addiction, one that redefined not just the economy, but the very meaning of value itself. Chapter 2. The Illusion of Relief. The first stimulus checks arrived when people needed them most. Rent was due, bills were piling up, and fear was everywhere. For millions, that sudden deposit felt like hope. Grocery stores were stocked again, small businesses reopened, and for the first time in months, spending returned. But this was a mirage, a flash of activity in a frozen economy. Supply chains were shattered, factories were closed, ports were jammed, money was flowing, but goods weren't. More cash was chasing fewer things, and simple economics tells us what happens next. Prices rise. Yet few noticed it at first. The stimulus created a false sense of recovery. People spent, but production hadn't caught up. It was like inflating a balloon that was already stretched thin. Every dollar printed seemed to buy less. Still, the illusion worked. For a while. Politicians praised themselves, markets rallied, and consumers celebrated. But deep inside the system, something fundamental was breaking. The economy wasn't healing. It was overheating. The illusion of free money was powerful, but illusions never last. When they fade, they leave behind something even more dangerous: consequences. Chapter 3. The Spending Surge. By the summer of 2020, America was spending like it hadn't in decades. E-commerce boomed, luxury goods sold out, and the stock market defied gravity. Trillions in stimulus had reignited demand, but not evenly. Some used their checks to survive, paying rent, clearing debt, keeping families fed. Others saw opportunity. Retail investors flooded into meme stocks, cryptocurrencies, and speculative trades. Companies like Amazon, Tesla, and Apple saw record profits as consumption soared. Meanwhile, small businesses, the supposed backbone of the economy, struggled to compete with lockdowns, supply shortages, and rising costs. The stimulus was supposed to save Main Street, but it turbocharged Wall Street. The wealth gap widened dramatically. Those who owned assets grew richer. Those who didn't fell behind. It wasn't a recovery, it was redistribution, disguised as relief. America was living through a once-in-a-generation spending spree, but it was built on borrowed time and borrowed money, and as the cash injections kept coming, the system grew increasingly dependent on them. The economy looked alive, but underneath, it was running on artificial adrenaline, temporary, powerful, and dangerously addictive. Chapter 4. When prices started to scream by early 2021, the first warning signs appeared. Gas prices climbed, groceries doubled, rent began creeping upward. Economists called it transitory inflation, blaming temporary disruptions and supply shortages. But it wasn't temporary. It was structural. Trillions of dollars had flooded into circulation, yet production remained crippled. Every new stimulus dollar added pressure. Inflation hit 40-year highs, but wages couldn't keep up. The average household's purchasing power began to fall. For families, the relief checks that once felt like salvation now felt like betrayal. Everything cost more, and savings evaporated faster. People started asking questions. How could so much money make life harder? The answer was simple. Because inflation is the silent tax of stimulus. It's the cost you don't see, the payment you can't avoid. By printing money, the government had shifted the burden from itself to everyone holding dollars. The price wasn't on your tax bill. It was on your receipt at the grocery store. And as inflation spread, the illusion of prosperity began to unravel. What was sold as relief had quietly become a robbery, one that took from everyone, especially those who needed help the most. Chapter 5. The corporate stimulus that no one voted for. While ordinary Americans were fighting to stay afloat, something else was happening behind closed doors. Corporations were being bailed out with billions. The same companies that had spent years buying back their own stock and avoiding taxes were suddenly too big to fail. The stimulus, designed to protect workers, ended up protecting shareholders. Wall Street received cheap loans, tax breaks, and government guarantees, while small businesses drowned in red tape. The wealthiest 1% saw their fortunes multiply as stock prices exploded, directly fueled by printed money. The real winners of stimulus were Native families struggling to buy milk. They were boardrooms watching their portfolios rise. It was the greatest wealth transfer in modern history. The government printed money for the people, but it flowed upward. The checks in mailboxes were crumbs compared to the trillions funneled through financial markets. And the cruelest part? It was all justified as economic recovery. But recovery for who? For most Americans, stimulus ended in higher prices and weaker savings. For the elites, it was a golden era of easy profit. The money meant for everyone became the privilege of a few. Chapter 6. The real estate ripple. The flood of cheap money didn't stop at Wall Street. It poured into housing. With interest rates near zero, buyers rushed in and prices exploded. Homes that once cost $300,000 now sold for $500,000 or more. Investors, hedge funds, and private equity firms began buying homes by the thousands, turning neighborhoods into corporate rental empires. For the average family, home ownership, the core of the American dream, slipped further away. Renters faced surging prices as landlords adjusted to inflation and rising demand. Stimulus checks that once helped pay rent couldn't keep up. The very money that was supposed to stabilize lives had now made stability unaffordable. It was a cruel twist, a rescue that inflated the one thing people needed most. The real estate market became another bubble, detached from reality but fueled by the same drug, cheap money. And when interest rates eventually rose, the market trembled. Some lost homes, others lost faith. The stimulus had turned shelter into speculation, and once again, the line between relief and ruin vanished overnight. Chapter 7. The birth of the inflation economy. As inflation spread across every sector, the economy entered a new phase, one where rising prices became normal. People stopped asking if things would get expensive. They just asked how much more. Wages rose slightly, but nowhere near fast enough. The middle class was shrinking, squeezed between debt and higher costs. For the first time in decades, Americans began dipping into savings just to survive. The stimulus boom had turned into an inflation trap. Everything, from eggs to electricity, became a reflection of monetary excess. Meanwhile, corporations used inflation as cover to raise prices even higher, padding profits while blaming global pressures. Consumers lost trust, workers demanded more, and the economy started fracturing under its own weight. The stimulus hadn't saved the economy, it had rewired it. A nation that once prided itself on productivity now lived in a cycle of spending and inflation. Every new dollar printed bought less and meant less. The inflation economy was born, and escaping it would prove harder than anyone imagined. Chapter 8. The Federal Reserve's Hangover. By 2022, the hangover hit. To control inflation, the Federal Reserve did the unthinkable. It raised interest rates at record speed. The free money era ended overnight. Markets panicked, stocks crashed, cryptocurrencies collapsed, and borrowing costs soared. Suddenly, those who had grown rich from cheap credit faced the other side of the equation: expensive debt. Small businesses that survived the pandemic couldn't survive the rate hikes. Housing froze. Banks holding long-term, low-interest bonds began to fail, leading to collapses like Silicon Valley Bank. It was a domino effect, the system detoxing from its own addiction to easy money. The same Federal Reserve that once promised temporary inflation was now fighting a fire it had started. The irony was brutal. The cure for inflation became the cause of recession, and once again, the people at the bottom bore the cost. It was proof that in modern finance, every bailout comes with a bill, and sooner or later, someone always has to pay it. Chapter 9. The Silent Cost. Public Trust. Beyond inflation and markets, something far more dangerous was eroding trust. Stimulus checks were meant to restore faith in government and the system. Instead, they exposed how fragile that system really was. People saw the richest get richer while their own lives grew harder. They saw politicians promise relief but deliver inequality. They watched as money lost meaning, and so did honesty. When trust in money fades, society follows. The stimulus didn't just change economics, it changed belief. People began turning to alternatives, crypto, gold, side hustles, anything that felt real in a world of printed illusions. The very idea of value became personal, not institutional. The government had given people cash, but it couldn't give back confidence. And without trust, even the strongest economy becomes hollow. Because once citizens stop believing in the fairness of the system, they stop participating in it. That's the hidden cost no one calculated. The slow decay of faith in the very thing that holds nations together. Belief in the money itself. Chapter 10. The Future of Free Money. Today, the world stands at a crossroads. Governments face a dilemma: keep printing and risk inflation, or stop and risk collapse. The era of free money isn't over, it's evolving. Digital currencies, central bank systems, and new forms of stimulus are already being tested. The next checks might not come in the mail. They might appear instantly on your phone, programmable, conditional, and traceable. But beneath the innovation lies the same question. How long can we sustain an economy built on promises instead of production? The more we rely on printed solutions, the less resilient we become. The truth is, stimulus checks didn't break the economy. They exposed it. They showed how fragile the global system really is when its foundation is faith, not fundamentals. The future of money will depend on one thing: whether we learned from this era or simply delayed the next crisis. Because the hidden cost of free money isn't inflation or debt. It's dependence. The kind that makes nations forget how to grow without printing, and people forget how to live without rescue. And when that dependency becomes normal, collapse is no longer a question of if, it's a matter of when. In the end, the story of the stimulus checks isn't just about economics, it's about consequences. What began as a promise to save the people became a quiet experiment in rewriting the rules of money itself. Governments learned that they could create trillions with a click. Corporations learned they could profit from crisis. And ordinary citizens learned that when the system gives you something for free, it's rarely without a catch. Because nothing in economics is ever truly free. Every dollar printed is borrowed from the future. Every bailout shifts the burden, and every temporary fix leaves a permanent scar. The stimulus didn't just flood the economy with cash, it flooded society with illusions. It made us believe that prosperity could be manufactured, that wealth could be downloaded, and that the laws of supply and demand could be ignored without consequence. But history never forgets. From Rome's debased coins to Weimar's hyperinflation, every empire that mistook printing for productivity paid the price. The United States, like those before it, now faces the same test. Can it rebuild real value after drowning in artificial wealth? The truth is, stimulus checks didn't break the economy, they revealed it. They showed us how fragile the system really is when faith replaces fundamentals. They exposed a society addicted to the idea of instant rescue and allergic to patience, production, and real growth. The hidden cost of free money isn't measured in trillions. It's measured in trust. And once that's gone, no check can buy it back. Because money may move the world, but belief gives it meaning. And when that belief starts to fade, even the richest nation learns that the most expensive thing you can ever print is confidence itself.